You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
I just tweeted a new graph this last weekend showing the valuations of the CDNX, the Toronto Stock Exchange Venture Index, made a new low against commodities in this cycle. So since 2008, we haven't seen a low like this. And that tells you a few things. It tells you you're at the bottom of this bottoming pattern. I think it's very late in this bottoming pattern, and we're on the verge of a very substantial rise.
Welcome back to Mining Stock Education. I'm your host, Bill Powers, and I'm speaking today with Willem Middelkoop. He is the founder and manager of the Commodity Discovery Fund, about a 200 million Canadian resource fund that focuses on junior mining stocks, which is very unique because not many funds of that size focus exclusively on junior mining stocks all over the world, but many of which are in North America where I reside. So Willem, thanks for coming back on the show today to talk about the sector and share your insights.
Thanks. Great to be back. And we just crossed the 200 million barrier because we see quite strong inflow from high net worth investors here in Europe. Many of these investors have clearly woken up because of the high inflation and the shortages they see arriving in the world of commodities and also in other markets, also due to the war, the Ukraine war. And to add a little to your introduction, yes, we focus on exploration companies, and I think we're the largest specialized resource fund out there who has this strong focus. But we also have at least 40% of our portfolio in more liquid stuff, and we prefer to use many of the ETFs and also the royalty companies, because if you're only invested in exploration companies, which tend to have a more illiquid trading pattern, it's very hard to change positions when you want to, especially during corrections.
Willem, if your fund just passed that 200 million Canadian mark, is there a point at which your fund gets too big to where you lose your competitive advantage?
Yes, that's a sensitive point. You should have asked that question. No, it's a great point, and we discuss this within our company quite a bit. We always say there's a sweet spot to be in this industry as a fund between, let's say, 100 million and 250 million Canadian. If you go over 250 million Canadian, you can still do a good job, but it becomes harder and harder to move the needle return-wise when you invest in very small companies making a possible tier one discovery. So we think we will do well up to 300 million Canadian. But if we pass that, we might. We are studying the idea of setting up a sister fund, which is more conservative and is more invested into the major commodity plays and ETFs. And that's a market you can invest billions and billions. And we also acknowledge that for some of our investors, our fund is a little bit maybe too volatile because we have very high returns on the way up, but also can have quite large drawdowns on the way down in correction, during correction years. So a few of our investors might like the idea to be in a more conservative fund. So we're thinking about that problem, but it's not a problem yet. But it could be a problem once we get a breakout of this correction pattern in the commodity markets, because as you know, you could easily end up with a year with another 100% gain, or 70 or 80 or 90% gain, which we already experienced 4 times since our inception in 2008. So then you could end up with 300-400 million easily, especially since we see very strong inflows. We have yearly inflows now of 70-80 million Canadian a year. And that all comes from high net worth investors, mainly from the Dutch-speaking languages. And we even had to raise the minimum amount of investments into our fund We increased it up to 50,000 euros from 25,000 euros. So that's about 75,000 Canadian, I think, because there was such a strong inflow of small high net worth investors.
Are you seeing inflows from institutional investors or just the high net worths?
No, just the high net worth. We don't focus on institutions. We don't want institutions, actually. It's a different market. They do different due diligence, and it's just more hassle. And when your returns are not good 2 quarters in a row, they leave very easily. And we have a very loyal investor base. We have almost 2,000 high net worth investors. And this model works great for us. So we focus on high net worth. But we do see the investment size, the tickets going up quite a bit. So almost every week we have people putting in 200,000-300,000 in one time. And we even see the people who invest into our new asset class, which is 1 million plus, and they have a lower cost structure. And we see quite a bit of these high tickets, large tickets arriving.
So you are positioned, as am I and most of my audience, in junior mining stocks right now. So for us to see these outside gains, we need to have retail gobbling up these shares that we already own. So what's going to bring retail into the sector?
Well, I think the Canadian market is, in a way, a bit broken, because we are really critical on the Canadian regulators. There's almost no punishment for insider trading. We see so many almost scam-like companies or lifestyle companies, and we've seen it with cannabis, and we've seen it with the crypto space, and you see it with the junior mining space. So I think many retail investors have stopped to invest in Canadian markets because they have been, almost scammed too much. And that's a very serious situation. And it's not discussed within Canada. It's a taboo. Nobody's speaking about this. But we from Europe will see much stronger regulation in our markets, and we also invest in Australian markets. And there's much more regulation in these, more professional markets, one could say. And this is really a message to the Canadian regulators. They really need to do their job. And instead of being a watchdog, they turned into a lapdog of the industry.
Yeah, that's an interesting perspective. I knew about the naked shorting that many were trying to get rid of in these Canadian small caps, but I had never heard that perspective from a European. Just when I talk with my American friends, we just basically said it's the wild, wild west. And you just got to understand you're getting into that. Like you said, you might get
it's worse. It's worse. Much worse than the wild, wild west. In the wild, wild west, you were shot if you met the wrong actors. Here, there's not even a slap on the wrist,
So how do you explain this to your investors then? What is the antidote to this?
We are becoming very, very, very selective, very conservative. We tweaked our investment approach a bit more to only invest in the top 100 undeveloped tier 1 and 2 mining projects and discoveries. So we stopped investing in pre-discovery. We stopped joining private placements in companies who are hoping to make a discovery. We are always waiting now for a confirmation of a serious discovery. We prefer to be 24 hours late instead of 3 years too early, and have all kind of like we used to call them death money, money which is not going to bring any returns. And we stopped to support many small companies because they just don't have enough traction. And sometimes they're good actors, but they just can't get enough traction. If you look at valuations in our industry, I just tweeted a new graph this last weekend. showing the valuations of the CDNX, the Toronto Stock Exchange Venture Index, made a new low against commodities in this cycle. So since 2008, we haven't seen a low like this. And that tells you a few things. It tells you you're at the bottom of this bottoming pattern. I think it's very late in this bottoming pattern, and we're on the verge of a very substantial rise. But it also tells you that the Toronto Stock Exchange index, where the smaller companies are listed, really has a problem, and that's the problem we just discussed. And there are just too many insiders playing these markets and trying to rip off other investors. And it's the retail investor is scared away.
So what would be, in light of this, what are some like your top 3 advice for a retail investor just getting into this market? We have a lot of them listening to us right now.
Oh, that's very easy. Don't try this at home. Yeah, sorry. No, but it's serious. If I want to be a biotech investor, I'm not going to try to research biotech myself. I'm going to look for the best and most liquid biotech ETF out there because, it's a profession. You just can't find discoveries by doing a bit of by going to the internet and going to co.ca and watch a few chat boards and then think you can outperform the professional. This is a market where professionals and insiders are very active. They play all the games they are used. They are used to play and can play in a legal or almost illegal way. And after being active in this market for 20 years myself, I think we now understand where the risks are. And we're getting more and more conservative. And we're down this year only 9%. And look at the index. I think Toronto Stock Exchange Venture Index is down over 20%. The Nasdaq is down over 30%.
So why is that, Willem? Is it like winners like Great Bear that lifted you up when the others went down?
That was last year. Great Bear has taken off the exchange now. But every year we have large winners. So we have a large position in Philo Mining. Huge discovery in the Andes. And we entered it late, around $8, but it has crossed 20. We have large positions in some amazing discoveries in Australia. Australia is really the continent where more and more discoveries are being made. I think Australia is underexplored compared to Canada. It's very hard to find new discoveries in Canada, really grassroots new discoveries, or in Canadian listed companies. So we're very successful in Australia. It took us a lot of time and energy to research Australia. It's a totally different market. And don't forget, you have 300-400 exploration companies listed there as well. And there's much higher regulation. The only problem there is that the outstanding shares are often in the billions. So you end up with share price of 1 or 2 cents. But percentage-wise, of course, the gains can be incredible there as well.
So for retail investors, if it's just avoid, would the best thing for a new retail investor to the sector to do, find the macro tailwinds that are going to be the strongest in the near term and buy the most quality juniors that are going to profit from those macro tailwinds? Would that be good advice?
Retail investors have a large disadvantage because they always because they have a normal job, or when they're pensioners, of course, they spend a lot of time. But if you want to do this serious, you need to spend over 40 hours a week to do your research. So that's very hard. So the best thing normally for investors to do is to find a good fund or ETF. ETF has an even lower cost structure. So I always advise people to buy the ETF. But of course, it's very hard to find a good ETF for the explorers. There's no ETF. You have the GDX for the producers, GDXJ, but these are junior producers. But there's not a really good ETF for the exploration space. And I think Van Eck or Sprott should start one, because that would be a better idea, or join a fund like ours. And there are a few more worldwide who really focus on this in this field, in this space.
So you avoid the pre-discovery. Are you avoiding pre-production? Because we've seen some disasters in companies that were trying to build a mine and a mill and come into commercial production.
Well, actually, our main focus is new discoveries, but our second focus is the re-rating in starting producers. So we always have this list available, and we always update this list of companies which will start production within the next 12 to 24 months. But you need to follow them very closely and wait for a breakout in the share price, because they have been trending lower often for years. And then wait for the breakout, preferably 6 to 12 months before commercial production starts. And then you should really watch the chart and the results. So every early sign that the start of production is not going well, you should sell them right away, because they can end up going bankrupt, as we have seen with a few of them, or go down 98%. But the ones who start production and become profitable, they will often gain 100, 200, 300%. And we've seen a few great examples of that, even in the last few years, because valuations are so low. You had Stepper Gold in Mongolia, nobody was watching them. I think they gained 300%. So it's an interesting field, but again, this is something, it's a great market for professionals like us, and it's difficult to play it at home.
So your Elliott wave analysis, which previous times I talked to you, you always use Elliott wave. Is that coinciding with this relationship between how low the TSXV is in relationship to the commodity complex?
Yeah, Elliott wave has greatly helped us to point where you are in the cycle. So all these major cycles, they have the same structure, because the larger investment audience always, acts like a herd. So they all start buying and selling around the same time. And with Elliott wave, it's quite easy to learn where you are in the cycle. And we had this huge run in 2020, but it was only a run of, I think, 5-6 months. So there was the move one higher. And then you had the correction, which we're in since the end of 2020. And this will bring a bottoming pattern, which is the 2. And we are there now. Actually, I think we're just starting to move out of that bottoming pattern, or will break out very soon. And then you're witnessing the start of the move 3, which is often the strongest and largest and longest move upward. So we expect a move up like we've seen in 2020, which brought returns of over 100% over a very short time frame. So we expect a jump of over 100%, but that this jump will take much longer. So that there could be a rally which would last or could last for years and bring precious metal stocks up 200, 250%. It can be compared to a jump we've seen in 2010, 2011, after the Lehman crash, 2009, 2010. That was actually a move 5. That's the last move in this long cycle. And that was a gain for our fund of over 300% in just 2 years. So I think it's an amazing situation. It's one of the best It's almost a once in a lifetime opportunity to enter this space. And that's why we see a lot of inflow as well.
And even with base metals, if we do have a severe recession, are you still bullish on base metals just based on, supply shortage?
Yeah, I think base metals has a little different cycle than the precious metals. If you also look at BHP and Rio Tinto, they do real well. The stocks have done real well. They're not bottoming out like the precious metal space. But you touched on another important point, which is the shortage in metals. And we always said one day after 2020, especially after 25, the shortages in raw materials and commodities will be a major news topic. And nobody could believe that in 2016 or 17 or 18. But now we're here, and shortages is all over the media. And not only in the metals, but also in the softer commodities and food. And you have the energy crisis, you have the food crisis now. And the in-house studies we did on the fundamental supply and demand topics all point to more serious shortages, especially after 2025. So it's bad now, but wait till we reach 2025, because there's almost no commodity which doesn't show a production deficit after 2025. And production deficit is one thing, but if you've got real physical shortages, that's another thing. And that I think we'll see that in the next few years.
Willem, your website is cdfund.com. And when I was perusing that in preparation for speaking with you today, I saw that you're hiring. You need an assistant fund manager, with your growth that you described earlier. A lot of smart people are listening to us. Maybe share a little more. Who are you looking for for that position?
Well, actually, we started that process a few months ago. We always had a relative small team of about 5 people who've been with us since 2011. We are now we just hired two new junior fund managers. And now we have a staff of 13, 14. We also use some people who work freelance. We have researchers now work for us full-time from Hong Kong and also from North America. So actually we're filled right now. But if people think they really can make the difference, they can always send us a mail. But actually the hiring process just stopped.
Excellent. Well, congratulations on your fund success, and I'll be touching base with you in about 6 months or so, Willem.
That's great. Thanks.